We're gonna go ahead and start recording this thing. Boom. But guys, this is actually a part two training. So for those of you guys that were here for the last Wyckoff training, just drop a one in the chat if you were here for the last one, or if you watched the last one. We had the recording that was emailed out to all registrants, same as this one. So you'll get the recording for this at the end, as well as some additional resources. And if you guys haven't checked it out already, definitely be sure to just go onto my YouTube channel, Donovan Taylor or at Donnie Dropout on YouTube. You'll see the Wyckoff training there in the video history, and there's a bunch of resources that are in the video description as well. If you registered for the last Wyckoff training call, which would have been not last Wednesday, but the Wednesday before, the if you register for that, you should have probably received the emailed recording and resources. But yeah, it was a great time last call, and we're looking to basically pick up where we left off on last training. And last training, we really got to the juicy part, and I do want to pay homage to anybody that wasn't here last training. So we're going to do a quick recap, and I think it's fair, even for the people that were here last training, to do a quick recap of what we discussed 2 weeks ago, and then how we're going to take it a step further on today's training. And the intention today is to spend most of our time looking at examples and actual application of Wyckoff in the markets, but we're also going to go back to some of the fundamental principles that you can actually find in that book, The Wyckoff Methodology in Depth, which was emailed to all participants last time, and that will be also emailed to all participants and registrants this time around as well. So if you're in a position where you're like, man, I want to get my hands on that book, you're in luck. Okay. Now, there's actually a couple other books that were sent over as well. But really, where did we leave off last time? Okay. In sharing my screen here and diving into it, we basically went over, we had a little bit of a slide deck put together. Okay, there's your buddy Richard D. Wyckoff guy. And really, Wyckoff is the missing link. Okay. Smart money is missing. Like a lot of people that are trading in accordance with institutional concepts or smart money don't fully understand where the ideology of smart money actually originated. And believe it or not, it was this gentleman right here who is really the grandfather, the godfather of smart money. And so Wyckoff Decoded was the name of the last training, and this is going to be Wyckoff Decoded 2.0, so taking it a step further. And we went over really the pillars, the four phases of Wyckoff, and we actually went into the book, read into this in some more detail. Really, there's three things to consider with Wyckoff. Okay, it's a system of reading market behavior. It's designed to track the intentions of institutional participants or smart money, the big fish, and it's based on price, volume, and time. And these are really the four different phases that we have in regards to Wyckoff. So you have the cause and effect phases, which are accumulation and the markup in the starting of any market. Okay, every single market that ever begins or is inceptualized, it starts in the phase of accumulation, followed by a markup. You then have the final two, which are distribution as the cause and markdown as the effect when we reach a high point in price. Now, these are the four basic phases of or not market structure, but of Wyckoff and market structure to a certain extent. Okay, there's cycles, all right, but there's more specific schematics that we overviewed on the last training in a lot of detail that we're not going to go over to the same extent of detail on this training. So if you're seeing this and you maybe missed the last one, I would encourage you to, if you're on the recording, to go down to this video description and click on the recording of the first lesson. Take some time, go over that, review it, and that way you at least have the context of what each of these, parts or phases of a Wyckoff accumulation schematic or, a Wyckoff distribution schematic are. That way you have the context leading into this recording. Okay. And if you're here live and you don't understand everything here, it's all good. Because you can obviously go back over the recording as well. And yeah, I'm happy to share the resources. They're all in. I'll actually show you guys, and I'll drop the link in the Zoom chat. Okay, they are all in the recording. If we go to the main channel here, okay, they're all actually in this recording. So pull this up, drop the link in the chat for you guys. This is for the first one. And again, if you're watching this in the recording, everything's just down in the description, but the actual resources are in the video description. So the whole slide deck, as well as bonus resources, are in here. So you have, I'll show you guys exactly what you have in this. So there's accumulation examples, okay, which are primarily what we focused on last time. Accumulation is something that I've personally trained my eye to see more easily, okay? As traders, we tend to be able to see one side of the market and one side of opportunities, buying or selling, a little bit more easier than the other. Drop in the chat. Let's actually, I'm curious to see how many of you guys find it easier to do one thing more than the other in trading, buying or selling. And drop in the chat whether it's buying or selling. What is your eye trained or tends to see a little bit more easier when you're doing analysis? Let me know in the chat. Okay, so longs for sure, me too. 100% buying, buying, accumulation, buying, 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 buying. Now both used to only say buying, buying, still learning, but buying, buying. Okay, so vast majority. All right, cool. We got a lot of buyers, and I would say that the average trader and investor is able to more easily identify opportunities to take buys than sells naturally because we psychologically want to see the value because that's what we associate it with, a chart and the value of an asset increase. That's how we naturally will see the charts is, we want to see an increase of value. We want to see the chart go up. And there's actually this is a sidebar, but relevant to those of you that want to take and apply this, but there's a success principle. I'm actually looking at one behind this computer screen for tracking on a chart your progress towards a goal. You naturally want to see the chart continue in a progressive fashion towards your attainment of the goal. So if you have a goal, let's say you're in sales, right? Or let's say you're trading and you want to track your account balance and you're, basically manually going ahead and drawing in, you're plotting the account balance as it's fluctuating up or down on any given trading day or in sales, every sale you get, you're pushing the needles forward towards that goal of, I don't know, 10K in a month or whatever it is, $1,000 in a month, whatever, right? You naturally, when you're looking at the chart and plotting it, will want to put in activity to cause the chart to go up. So the same kind of principle applies when we're looking at, any sort of market. We often are going to be able to identify buying more easily than selling opportunities, buying opportunities more easily than selling opportunities because we want to see the value increase. We want to see an uptrend. Okay, so just kind of an interesting phenomena. But it's important to train your eye to see both sides. Because think about this, if you're only really able to identify or you tend to have like this mental um, habitual way of analyzing the market where you're only really able to or not only able to, but you like mainly are analyzing and looking for buying opportunities, you might see something or convince yourself that you're seeing something that's opportune that actually isn't. And you're overlooking a whole other side of opportunity to take shorts or sells that otherwise are presenting themselves with these different schematics and just smart money in general, right? The basics of smart money, order blocks for value gaps, whatever the case may be. So just food for thought, but charting and plotting towards your goal is really effective, and I encourage everybody to do so. It's a great way of plotting and pushing the needles forward in your business or with whatever goals that you have that are measurable in general. So again, we're not going to go over all the minor details of like what is a preliminary support or PS, what is a seller's climax, an automatic rally, secondary test, STNB, a spring, a test, a sign of strength. Okay, last point of support, last point of supply. in a bearish environment. Okay, we're not going to go over all the minor details and labeling in this training, but if you want that, you can go and you can check out the recording. It's public on my YouTube. And the link is probably in this video description if you're on the recording. And once again, I'll drop it in the Zoom chat for you guys. Okay. So where are we going to go from here today? Okay. We're going to go into and focus primarily on more examples. And I'm going to give you guys a couple examples from more recently because I think it's a bit easier for us to pull back up in the data. And then what we can do as well for those guys that are here live is if you have charts that you maybe want to take some time while you're on today's call to mark up or to review. You don't have to do the entire labeling, okay? You don't have to, go about labeling it entirely, but more simply, and we talked about this on the call, 2 weeks ago as well, how you can simplify Wyckoff to, really just three drives, okay? You have first drive, second drive, third drive, markdown. Or in a bullish environment, a bullish scenario, you have three drives where it's whoops, first drive, second drive, third drive markup. And in the schematic number two examples, we have the third drive, which actually doesn't even capture the low of the second drive. All right, but looking for these three drive patterns. So if you guys want to take some time, and I'm happy to give some feedback, or we could just take a look at some examples together. I want this to be interactive because we have a bit of a tighter knit group today. Feel free to drop some examples in the chat. Take some time. Today's going to be less, textbook educating. We're going to take a look at the text, the textbook. We'll call it the textbook, the Wyckoff methodology in depth book. We'll take a look at it a little bit today because there is a couple of things that I wanted to spend some more time on. But mostly today is going to be looking at examples and training your eye to see this stuff. And the more that you train your eye to see this stuff, which is, just every day taking a look at and doing analysis, or every day that you tend to trade, looking at and doing analysis, or even back testing, which I think is a great habit to get into, you want to train your eye so that way when price is developing, you're able to anticipate, okay, this is where we could be based on what you're seeing. There's the quote that we shared from my buddy Richard. Where was it here? I actually think it was in one of the notes. Yeah, here it is. So the successful trader acts according to what the market is telling him, not what he wants to believe. All right, and this is a key point because a lot of the times we'll convince ourselves of opportunities that aren't actually necessarily there in accordance with what the market is actually showing us. For example, okay, I'll be honest because this is an example for me more recently. I really want to see Bitcoin retrace. And I've been trying to take sells. I'll be so honest with you guys. I've been trying to take sells on this thing for the past week. Stopped out, stopped out, stopped out, right? I am currently up on an Ethereum sell. Ethereum, decided to give a nice move. But the opportunities that I was looking at or convincing myself that were present weren't actually there. Okay. And I think something that's important to note as well. I wish I had this screenshot. I have a really good screenshot somewhere that kind of shows the relationship of time frames and how the higher the time frame, or the higher time frames just in general will trump the smaller time frames. It's like a cool illustration with like nights and stuff. I can't remember where it is. I don't have it on this laptop, but something that's really key to understand is the cause and effect relationship, which I want to go to the textbook for. Okay, the cause and effect relationship where we have accumulation, which is a cause at a low point prior to the markup, the move higher. The cause and the effect will always be proportionate to one another. All right, so why don't we actually we'll pull this up real quick. Okay, I think if there's a time for us to get into the text, it'll be right now before we dive into some more examples. But I actually want to read over part of the book with you guys on the section about cause and effect. So let me pull this up real quick. So this is directly from the book. Again, I'm not the creator of this stuff. I'm just someone who's fascinated by Wyckoff and understanding the institutional involvement in the markets at a high level because I understand that when you understand how or when you can position yourself in accordance with the major institutions and understand how they are positioning themselves, you can be on the right side of really major moves. And that's how you can be the type of trader that is not just catching 1 to 3, 1 to 5, 1 to 8 risk reward ratio setups, but rather 1 to 20, 1 to 40, 1 to 50 risk reward ratio setups. And it's really understanding how the fractal nature of the market unfolds, taking a look at higher time frames, moving down to smaller time frames, having a higher time frame bias with smaller time frame, more refined entries. And so really that's the whole goal with Wyckoff is getting to a point where you're able to identify these high probability setups and not just for a 1 to 3 or 1 to 5, but being able to hold some of these trades for really incredible swings. So um, where or how exactly where exactly I start to measure the effect part? That's a good question. We can get into that. So, and notice how there's an example here too. We'll take a look at this. So, chapter 8 is all about the law of cause and effect. Now, keep in mind, there's 7 chapters of context prior to this that we're skipping over. Um, is it all absolutely crucial to have as context? Not necessarily, but let's be honest. It's definitely going to support to a certain extent with understanding. So we are just understand it's important to read through the entirety of the textbook of the book. Okay, so let's get into this. Okay, the idea is that something cannot happen out of nowhere. That to see a change in price, a root cause must first have been built. Generally, causes are constructed through a major change of hands between well-informed and uninformed traders. This is a key point. All right, if you're taking notes, this is a whole sentence that I would encourage you guys to note. All right, the cause is constructed through a major change of hands between well-informed and uninformed traders. This is through liquidity captures, and it's also through basically traders being led to feel certain emotions, greed or fear, typically fear. So let's continue. In the case of individual transactions, the cause for the price to rise is the buyer's desire to want those shares or the seller's desire to want that money. In addition to seeing the cause in terms of an individual trading, the objective is to see the cause from a broader perspective in terms of movements. For this, it is said that the market has constructed a or is constructing a cause during periods of price lateralization, accumulation or distribution, and that these generate later as an effect a trend movement to rise or to fall. In these lateralization periods, stock absorption campaigns are carried out in which the big traders begin to position themselves on the right side of the market, gradually expelling the rest of the participants until they find the path on which price will be directed free of resistance. Think about that for a second. Big traders begin to position themselves on the right side of the market, gradually expelling the rest of the participants until they find the path of least resistance, essentially, is what this line is stating. So when we zoom in here and we take a look at the diagram, which I can't pull up full screen, but we can kind of take a look at here. This is actually written in Spanish. Okay, you have Euro USD, you have lateralization or more or less consolidation at a high point, followed by a pretty aggressive move lower. To answer your question, Brock, the way I'm always going to look at the effect is going to be from the highest point to the lowest point of the move. So kind of the same way you would draw the fib. And then same thing where we have the lateralization, the accumulation down here. I'm going to measure it from the lowest point to the highest point. So basically from that UTAD or that spring, or if you have a type 2 schematic, you would consider that as well. That's usually how you're going to want to look at and measure the effect. So we'll come back to another diagram. I believe there's more than just this one in this particular chapter. An important aspect of this law is that the effect realized by the cause will always be in direct proportion to that cause. Consequently, a greater cause will produce a greater effect, and a small cause will produce a lesser effect or result in a lesser effect. It is logical to think that the longer the period of time the market spends in a rank condition developing a campaign, the greater the distance the subsequent trend movement will travel. So, in simple terms, the longer we spend accumulating or the longer we spend distributing, usually the bigger the move's going to be out of that area of consolidation. So in what matter, there's an equality in them. Seems like a smaller cause than the effect in the diagram. So from the looks of this, obviously there's more context that's missing to the left. If we were to take it for face value, this kind of looks like a smaller distribution than this accumulation, despite the move being bigger than this move, and it looks like we're going to continue lower in this chart at a glance. What we're missing is more to the left. There could be more data over here that could make this whole zone look like a technical area of distribution or a greater, higher time frame distribution than just that which is marked up. But for the purpose of this diagram, I think it was just good to illustrate a cause and effect relationship, not so much the proportions. And we'll take a look at this with some more examples. In continuing, it is logical to think that the longer period of time the market spends in a ranked condition developing a campaign, the greater the distance the subsequent trend movement will travel. So again, usually you'll see a more major move from the longer periods of time that we spend consolidating. The key is to understand that during the lateral price phases that the accumulation or distribution processes take place. So it's to understand that it is during that time when you'll see accumulation and distribution. And obviously, you can read based on the nuances, based on the little finer details, what's actually going to be taking place, either accumulation or redistribution, because they both look very similar, or distribution, or perhaps reaccumulation. And that's what we're going to spend a bit more time on today as well, is the differences and the things that you can kind of look out for to lead you to believe or anticipate what price will do in accordance with how it's developing. Depending on its duration and the efforts we see during its formation, manipulation maneuvers such as shaking out or, the spring, the STB, stuff like that, stop ons essentially, this cause will provoke a response, movement upwards or downwards in effect. Okay. Elements to bear in mind, point and figure graphics. Obviously, there's more that you can get into in more detail here. We're not going to get into all the finer details, but let me see if there's anything else that I wanted to go over. Yeah, this is a good section too. So we'll skip over the points and figures. You guys can read over that in your own time. Technical analysis from projection, projection of objectives. So there are traders who consider that the projection of targets, or who consider that the projection of targets by counting the point and figure graph is not very operative in today's markets. I'm one of those people, so we're not going to spend much time on it. There's also a problem with the point and figure at the time of its preparation. Okay, what's the part that's relevant to read here? Some of us prefer to simplify it and use tools such as Fibonacci and Elliott wave or harmonic patterns, vertical projection of the range for the projection of targets. This is a key point. It's basically how to gauge and project the size of moves based on the time spent in a certain area. This type of tool or these types of tools are becoming more and more powerful since the inclusion of software and financial markets, many algorithms, da da da. Okay. So it doesn't really go into it in a whole lot of detail, but basically, if you were to measure out, and the way that kind of being shown in this screenshot is important, so we're going to zoom in on this. The way that the proportions are being considered here is from the buyer's climax to the low created from that automatic reaction, and vice versa from the seller's climax to the high created by the automatic rally. So the same way that we would be just zoning out the accumulation or the distribution is how we're also going to gauge the size and or duration of that effect. Not necessarily duration, but more so the size. Okay. So if we were to take, a duplicated box here, this is kind of what's being measured out, right? So notice how the lateralization at the high point here basically duplicates itself almost one entire tier lower, a little bit beyond that. Okay. Even if we were to duplicate this once more, you can kind of see how it's almost three stacked on top of each other to get you down to that next accumulation, right? And then we see similarly with the size of this accumulation, again, just a rough drawing, you can kind of see the proportion that is practically to a T here of where the high is established before the continuation lower. So, and we're going to take a look at some actual examples of this, but this is an important thing to consider. Key points to maybe write down if you haven't taken notes so far is that it's kind of like that law, the law of cause and effect. Does can't remember, was it Isaac Newton or no? Can't remember who it was. It's like an object in motion tends to remain in motion. Yes, we know that, but also every action has an equal and opposite reaction. I think maybe that was Einstein. I don't know. Can't remember who it was. But similar thing can be considered in the markets. So if we pull up the charts again here, okay, see if we can go like that. Boom. So in taking a look at a couple examples, and we're going to take a look at the Bitcoin chart here because there's a good example. We took a look at this a little bit last Wyckoff training as well, but we'll pull it up here. If we were to take a look at the current price action that we're seeing on Bitcoin and how we almost have this simple three drive potential accumulation that's taken place here. The way we would be essentially measuring this in terms of the size or anticipated move to the upside would be from the low of the seller's climax, which would be the first drive, to the high of the automatic rally, which would be this high here. And we would basically want to take this and essentially, we'll actually make this a little bit more easy to see. Let's make it green. We would take this and we would essentially duplicate it, put it one on top of the other. You can also do this with Fibonacci very simply by literally just taking a fib, going from low to high, and then this -1 extension level will be a duplication of the move in the exact size and scope. So if you go into the fib settings, you're just going to want to add on -1. Right? -2 would be two on top of each other. Okay. And you can also do this with, and we talk about this on other trainings on market structure and fib, but, the way you could measure from, let's say, this low to the high and use those kind of kill zone levels as targets, you'll kind of see a relationship and similarity here with projections. But again, it's not always going to be in this case or scenario, it's not going to be a projection to where the top will be before reversal or usually what it's going to be if this is the start of a market cycle. Okay, there's four phases in a market cycle. You have accumulation, which is the starting point. If we're looking at this, obviously it's in the middle of trend. We know it's not like the very first accumulation. But if we were to say that this was a distribution, we had an accumulation that came sequentially right afterwards. Accumulation will tend to lead into a reaccumulation, followed by then a distribution to go lower. So it doesn't always mean that, when we make an identical move higher here, that we're going to see that be the top. And for something like Bitcoin, the high is in for the whole run. That could be a scenario, but probably what will be more likely is we'll get a reaccumulation to then get one more move higher. And again, you can zone this out, project this the same way we would be doing it here. Hopefully that's, not too complex, but hopefully that made sense. All right, but again, we'll do this with zones just to make it a little bit more visibly easy to see. This is the type of projection, if we were to look at this from, cause and effect, how to project this move. You're measuring from the low of the seller's climax to the high of the automatic rally. And that's how we basically fib this out. And this is what we would be anticipating to be kind of the extent of the move. And again, this could just be where we get another reaccumulation. This could be where we maybe top out. This would be very similar to the previous bull market if we were to just get one more run on this high and then that was the top of the run. I don't personally think that's going to be the case for Bitcoin. I think we got a little bit more gas in the tank beyond 110K, but let's see what happens. This is just, take it with a grain of salt, okay? Obviously, we could go way beyond this. Maybe we don't reach that high. This is, again, it's just a way of looking at and anticipating the cause and then the sequential and proportionate effect. Why do you think we're going to get another accumulation? Typically, in a market cycle, I have this cheat sheet I'll pull up. A full market cycle, a healthy market cycle will include all four phases of Wyckoff, which are essentially, oh, I don't actually have it on this computer. Hold on, let me see if I can find it real quick from my Telegram. I have a training that does go over this as well in more detail, but market cycle illustrated. Actually, I think I do have this in the slideshow. Hold up. Yeah, here it is. Let me pull this up for you guys. So we will typically get these as the four phases of an entire market cycle. So you have an accumulation, start of the cycle, followed by a reaccumulation, followed by a distribution, which is usually the beginning of a retracement or the end of a, bullish cycle. And then you'll get that redistribution or perhaps just the start of a new accumulation to then give you that beginning of the next cycle. So if we were to take a look at this and consider this with Bitcoin, depending on what time frame we're looking at, right? We had basically, we'll actually look at this on the weekly real quick. From the high of 2021, okay, we almost had like a distribution with like a second smaller distribution, but ultimately just a major run on liquidity to trade lower. Here you have redistribution. We then have the accumulation. Okay, the way I would be marking this up, even just to give it a glance with the projections to see the level of accuracy with this, I would probably measure from this low being the seller's climax with, probably smaller time frame that might look a little bit cleaner. But this being the seller's climax followed by the automatic rally. Automatic rally is probably going to be more. Let's actually see this on the daily real quick. Definitely preliminary support here. Melted through that. The major redistribution was right here. You could look at this as a potentially accumulation schematic, but notice how we break higher and then fail to respect the lows here and just melt through it. Okay, this is a failed accumulation turned into a redistribution. You then have your preliminary support that fails, right? We then have the low that's established. How we would look at this to measure it with the automatic rally and ST, it's you know, kind of subjective, right? We probably would want to measure it. Yeah, it's little bit subjective for this one, how we would measure this. Either way, though, just to get an idea of how this would look, if you were to measure it like this, where maybe we had, this drawn for, your high of the automatic reaction, -1 equates to kind of where we ended up reaccumulating to go higher. if you were to measure this from, let's say this high, right? -1 kind of aligns us with, again, where we get the start of this reaccumulation. If we were to put on -2, I think this will be kind of in line with that same reaccumulation once again. So again, you don't want to be super overly technical with it. But the point is, the reason I wanted to pull this up is we've had on the weekly time frame an accumulation, right? And one might even look at this as like one big accumulation, all right? Depending on, you know, who's looking at this, who's analyzing this, how you're looking at it. We've had a accumulation followed by one reaccumulation. You can have multiple in a cycle. And we know that this is a reaccumulation because it looked very similar to a distribution, but it failed because we got a mark higher to, 100,000. Okay. We've now seen on the weekly time frame, this is looking to be the start of what could be a distribution. All right. If we're taking a look at this, we've had, you know, it's a little bit of a weird one to mark out if we were to look at this as a distribution. All right. If we were to pull this up and liken it to one of these diagrams, we don't really have the picture perfect on the weekly, at least picture perfect, you know, glance or look at this here. Um, and to me, I'm looking at this as another reaccumulation ultimately on the weekly perspective. Any sort of a retracement, there's a way for you to look at and identify it as a reaccumulation. Just, for the record, because you'll get movement. This right here, smaller time frame reaccumulation, movement. This was a major weekly time frame reaccum that took, I mean, we were here for a while. From the highest point that we established to the breakout, this was like 238 days, and then we had a breakout from November to, basically the highest point here was established about 70 days later. And again, if we were to take this into consideration, measuring the buyer's climax to the automatic reaction, which we're going to want to flip this because of the way I drew it. Look at the projection here. So -1, -2, kind of in line with where we top out. And then we've got this smaller time frame, daily time frame. This does look like a distro. You could probably mark this up and in some way, shape, or form identify the distro. We now get that mark lower and the start of an accumulation. Not so much of a redistribution on this in this particular example. Your targets are standard deviations. Yeah, essentially. Essentially, they would be standard deviations. Exactly. Yeah. But really clean reaccumulation schematic here. If we were to take a look at the cheat sheets, okay, it's actually not in this. It's in this PDF right here. There's some wonky ones. But if we take a look at a reaccumulation schematic, it's very, very similar to, in fact, it's practically the exact same as the, hold on, where's my, oh, cool. I can do a spotlight. Neat. Oops. Okay, where's my pen? There it is. Having too much fun. So this is very similar to a distribution. You have buyer's climax, automatic reaction, okay, ST. In phase B, there's also an ST here. You got a seller's climax, interestingly, another automatic reaction, followed by a spring, and then a jump across the creek, which is basically this little thingy here. Spring test, LPS, breakout to the upside. So it almost looks like a distribution where you kind of have first drive, second drive, third drive, followed by a run on these lows. You could look at this as like a sign of weakness in SOW initially, but then we actually trade and we break higher. A good example of this was on gold in okay, how do I get rid of this arrow? This arrow out of here. There we go. Was on gold back in I don't know if this is the best example in the world actually, but we had like a pretty major um liquidity capture right here on on Goldilocks where I'm willing to bet a lot of people were anticipating us to, this is like a market structure shift. People were probably selling here, selling here. Oh yeah, we're gonna go lower, and then we just ended up flying, you know. You could probably liken this whole section here to a failed distribution turned into a reaccumulation to go higher. And that's the way I want you guys to kind of train your eye to see it. It's not always going to be picture perfect. All right, I'll be the first one to tell you. Okay. This is a lot to take in for sure. For sure. Wyckoff, I'll be honest. Wyckoff is advanced. Like this is advanced stuff. This is advanced stuff. And my most important punchline that I'll give you guys on these trainings, because this is not the last one. All right, it's not the first, it won't be the last, is that you don't want to lose yourself in the sauce. With Wyckoff, the most difficult part is overcomplicating it and trying not to overcomplicate it. Because you could look at this and be like, all right, I know every single label to a T. You'll notice that most of the examples we're going to take a look at today, I'm not going to spend the time marking out every single label, and some are going to be cleaner than others. Some might look like garbage. The most simple way to look at it is from the three drive perspective. So, and again, this right here isn't the best example, but you have your PSY that fails. You've got a drive here, daily time frame, just one candle that retraces. We get a high here, followed by a pretty big mark lower. Okay, a lot of people looking at this as a market structure shift. Price trades back up. We reject. Once again, we reject. This is looking like a head and shoulders pattern. You got retail traders that are selling. You got smart money traders that are selling off the fair value or thinking, oh man, we came and reacted beautifully off the fair value gap. We're probably going to come for this low next. Okay. But this whole time, what the institutions were really looking to do was shake out the majority of buyers. This was at 2,800. Like this was all-time high price, at the time. But the whole time, this is your spring right here. Here's your test. Also a nice fair value gap fill, by the way. We were talking about this back in November. The likelihood of us getting a shakeout and then, seeing a nice move higher. And that's what we end up getting, right? And this is not the picture perfect reaccumulation schematic, but you could probably find one that kind of looks a little bit similar. This is probably more so what we're looking at here is like a type 4, because it's got a pretty major sell-off. That's kind of like what we have right here. Pretty major sell-off. If we pull this up over here, you've got a couple relatively equal lows, but higher low nonetheless, right? Springs actually maybe right here, took some liquidity there too, however you want to look at it. Again, you can overcomplicate Wyckoff very easily. The bottom line is this. Number one, write this down in your notes. If you want to keep this super, super simple for yourself, here's how you can make it so easy and so simple. Okay, write this down. Number one thing you're looking for is liquidity captures. Number two is how many times have we seen liquidity captures? It's basically the same thing. You're looking for liquidity captures, and then you're asking yourself, how many times have we seen liquidity captures in an area of consolidation? This is a little bit of a different example because this is in the middle of the trend. We're trending higher. spending a little bit of time consolidating, but ultimately it's a reaccumulation to go higher. So it's not the best way to, or best time to identify liquidity captures. Mainly what I'm referring to here is those highs where we're chopping and those lows where we're chopping. How many times have we seen liquidity captured? Or how many times have we seen liquidity captures? Okay. And ideally, you're seeing a minimum of two. Because think about it. If we're taking into consideration, we'll actually keep this pulled up for now. Even a distribution schematic, right? Prime example. Have we seen at least two liquidity captures? Most of the time, a buyer's climax is going to also be a liquidity capture for something on the left. All right. The second liquidity capture is the buyer's climax high being taken out. Just the exact same way, as above, so below, that we're going to have an accumulation schematic with a seller's climax that in and of itself is probably a liquidity capture. The second liquidity capture is always going to be the low of the seller's climax being taken out with the ST. Why do we say has there been at least two? Because there's not always going to be the third. You're not always going to see a spring. First drive, second drive, third drive can be lower. That's the ideal scenario. Those are my favorite scenarios. Or they can be higher. So you won't necessarily have a liquidity capture. It'll just be a higher low. So if you want to position yourself to ideally be on the right side of the move before it happens without getting stop hunted, right? Then you ideally want to ask yourself these questions. Okay. Well, I guess it's, things to consider, right? Number one, liquidity captures. Number two, you're asking yourself these two questions. How many have we seen so far? And have there at least been two? So when we're taking a look at even just this reaccumulation schematic, for example, you might look at this and be like, well, Don, you only have one liquidity capture here when this low is created. And I would say, okay, sure. But here's the thing. This sell-off capturing a ton of liquidity. There's a liquidity capture there on the way down to create this one. We also had after this one was created and the rally takes place, the test down into this area and this fair value gap fill. This was also a liquidity capture, right? But ideally, again, we're not, you don't want to. I would say for Wyckoff to be kept most simply, you want to, especially when you're first starting out and analyzing this stuff, you want to focus primarily on just accumulation and distribution schematics, not focusing too much on the reaccumulations and redistributions, just understanding, hey, if we have consolidation at a high point and it breaks lower, but then trades higher again, that's a failed distribution turned into a reaccumulation. Okay. So let's jump back over to Bitcoin because I actually wanted to continue speaking about this. All right. Again, we could, spend time theorizing or what's the word I'm looking for? Speculating on what Bitcoin's going to do next. Okay. All I'm going to say is this. We have very clearly three different drives. The creation of these sellers climax in and of itself was a liquidity capture because we took out a bunch of lows on the way down. All right. Even if you're looking at this as the PS, and not the seller's climax, whatever, however you're looking at it, okay. First, liquidity capture. Second, from the taking of the first. Third, the taking of the second. So the question of have we seen at least two liquidity captures is absolutely yes. One, two, or depending on how you're looking at it, one, two, three. All right. So I'd say this thing's, looking great to continue higher. But I do expect a retracement at least to the top of this kind of range. This is really where I'm looking for Bitcoin to retrace to. Nice little area between 88 and 92,000, which I think we're going to get pretty soon. Maybe going into next week. What do we have for moon phases, by the way? I'm curious. Yeah, so full moons usually lows, new moons are usually high points on Bitcoin. So we've got until probably about mid-May before the next full moon. Usually we'll move from low points to high points, from full moons to new moons. All right, if we were to take a look at gold right now, we're not going to take a look at moon phases for this, but on a smaller time frame, because we got a lot of gold traders here. Okay. This to me, the consolidation that we're looking at right now, initially looked like an accumulation schematic. The way I had this marked out was actually initially as a accumulation. Based on what we're seeing in terms of price, based on what we're seeing in terms of price, this is looking like a failed accumulation turning into a redistro. Could I be wrong? Yes. Maybe this is going to end up being an accumulation to go higher. But because of how long we're staying in this range and the way that I had this marked out originally, I think I even have it labeled, was you know, couple preliminary supports that get run through. You have your seller's climax followed by automatic rally, ST, a high that's just above the AR. And here we test the low a number of times, break higher. We trade back into a fair value gap, get what was looking like a fractal accumulation on a smaller time frame that also failed. We mark lower, got a little bit of a bounce, and it's looking like we're going to melt down to this area at 3250. But instead of it being, and we'll see what happens ultimately, we got NFP this week too, so we will see. But the way I'm looking at this now is actually as a failed accumulation turning into a redistro. Uh, could I be incorrect? For sure. Like I said, definitely. It's not off the table for this still to be an accumulation. But I would say that this is looking more like a redistribution than it is an accumulation. If we take a look at some examples here of redistribution schematics, we have the preliminary support, seller's climax, automatic rally, followed by in this case, is a sign of weakness in schematic one, so that's incorrect for what we're looking at. This is probably more like what we're dealing with. We've got, yeah, even this one's a little bit different from what we're dealing with here. And again, this is where it can kind of be, you don't want to overthink it. You want to get overly technical. But either way, this doesn't look strong at the moment to me. I mean, if we mark lower, which I do think we will, I'm less confident in us getting a bounce from 3250 because this just looks like weak price action. And we've been consolidating here for quite some time. Could we get a jab on the lows and then we trade higher? Yeah, totally. Like it's not completely off the table. But based on the way that we're printing right now, I wouldn't be as confident in buys from this low at 3250. Whereas if we were, having the conversation back on Sunday, which we were, different story. But both times we had failed to actually get that sweep of this low. This was last week. This was on Sunday. This is where we're at again today. Even if today we jabbed the low, it would have been more confident for taking buys on this. This thing is looking super weak. Um, you know, we're being supported down here. A lot of people are probably looking at this like, oh my gosh, my support zone, right? But the more touches you have in a zone, the more likely there's going to be what? Buyers with stop losses beneath the lows. So let's see what happens tomorrow. Let's see, maybe we get a V-shaped recovery. Even tonight, we could see this. You can look at every time frame for Wyckoff. You can see it on every time frame. Just like any other concept in the markets, you can see this across multiple time frames. So, okay, let's take a look at some other examples. I want to take a look at Euro USD. I'll actually do this on a clean chart. Euro USD. Okay, we've got an area. Look at this on the 4 hour. And you guys let me know. Actually, let's take even take a look at this in terms of the proportions. What does this look like to you guys? Let me know in the chat. What do you guys think this looks like on Euro USD, where we're currently trading? Accumulation to sell. So a distribution at a high point, right? Consolidation at a high point is usually something we'd be referring to as distribution. Okay, so this is an area of consolidation. I think we can all agree this is, looking like an area of consolidation. We had a mark higher, traded back into this zone, just been chopping sideways, chopping sideways. Because we're at a high point in price, this would be one of two things. Either it's a distribution to mark lower, or it is a reaccumulation where we'll have a mark lower, but price will ultimately continue higher. Okay. But either way, we have room to the downside here in this particular scenario. Excuse me. So, how we would look at this again to keep it very simple. Again, simplicity is what will make you the most money in trading. I'll be the first one to tell you, I used to look at these schematics and I still love finding picture perfect schematics. Do not get me wrong. They are my favorite things to show. It's kind of like I don't know, man. It's like even when you're educating, you just want to find the picture perfect setups to educate on. But I've come to realize over the years that you don't want to always show picture perfect setups because the amount of times that you get picture perfect opportunities is very, very rare to actually execute a perfect. Like I'll show you an example on a smaller time frame for gold um from yesterday that I was in for buys that looked beautiful, absolutely beautiful, that ended up being a redistribution to go lower. But here's the point. The point is you want to keep it simple. And the way I'm going to look at this is, again, I'm going to ask myself those questions. So I'm looking for liquidity captures. All right, I can identify that there was one right here. This high got captured. We created this high. We then traded lower. We then had this move higher, which captured the sequential highs, these kind of all at once. Okay, if we zoom out to the left, oh, that's a good quote. If you know the source of your success, you can repeat it. If you know the source of your failure, you can avoid it. Must have been doing a training back here, right? But even more significantly, we had a higher time frame area of liquidity that was captured. Okay, this high on euro at around 115 was taken by that same move. So we have liquidity capture on a small time frame number one, liquidity capture two, major liquidity capture, both smaller time frames and higher time frame. Okay, so we've had at least two liquidity captures here. Is Euro USD ready to trade lower? It definitely could be. We've had two drives, right? We got one drive, two drives, We're kind of waiting for a third one. Either we get a poke above this high, or this was kind of like the really weak third drive and this thing's ready to go lower. Okay. Either way, we can anticipate movement lower. But I would love to see, I will say this, I would love to see a move to this order block for sells, but I don't think we're going to get it, to be honest. We already got it on GU, but for Euro, it's been lagging quite a bit behind, and it's looking a lot weaker just in general. So we do have at least two liquidity captures. This is the first drive, second drive again. First drive took out the high here. Second drive, we're taking out multiple highs, higher time frame, also seeing that taken out. If we go down to the hourly, okay, we're seeing what could have been looked at as a potential accumulation here. It's not the best example. Again, very choppy, very sideways. Only, one sweep of liquidity here to the left, and then this low just remains intact. We don't take it ever since. So there's a ton of liquidity beneath these lows, right? So the likelihood of this to trade lower is, I would say, pretty high based on what we're seeing. We've seen two liquidity captures on the buy side with basically only one so far on the sell side. And we haven't even taken out the low of the first drive yet, technically. Okay, if we're looking at this as like a 1, 2, 3 movement, you know, buyer's climax, automatic reaction, ST, SOW, if you're looking at it that way from, having to label it for a distribution, we haven't really even seen a break below this yet. And usually you will. In a distribution, you usually will see it. Um, does it always need to be in phase B? No. Sometimes it'll be after, phase C that we get a break below it, right? But either way, we're anticipating these lows to be taken out. Okay. If we take a look at something like AUD USD, kind of a similar story, but different. Okay. Similar story, but different. We've been consolidating and chopping sideways in this zone on AU for a while. I think since like the beginning of April, basically. We came to trade and create this high. I guess it's been a couple weeks, right? But this whole zone is just choppy, sideways, ugly, boring price action. And how many opinions are being formulated in a time of consolidation, right? Think about it. We have an area of quote unquote resistance that people are selling from. You have an area of quote unquote support that people are buying from. So these areas, again, think about what it was saying in the text. Areas of consolidation is where there is a transfer of wealth taking place. There's a transfer of stock, a transfer of positions that are being held in the market from those that are uninformed to those that are actually informed. And in this particular scenario, we've had, a nice run on liquidity here. Okay. On the way to create this high, there was major liquidity captured. So we've seen at least two captures. Is there going to be a third one? Potentially. I mean, I would even say that this is looking like it's on route to potentially capture this high. We've also had some captures on liquidity on the sell side here, but ultimately we've still got a lot of lows intact. So my anticipation is one more drive to then break these lows, personally, on AUD USD. But I'm liking this as a distribution schematic to trade lower. Okay. Or it's a reaccumulation to go higher, right? But ultimately, based on what we're seeing and what is the classification that we would look for, or the type of price action that we would look for to confirm this as either a redistribution or a reaccumulation, it's usually the fact that if and as to when we get a UTAD, a move above this kind of distribution and consolidation range, it's usually returning back into the range fairly quickly. Not breaking through the range, and then we start to consolidate up here for, I don't know, 4 or 5 hours. Not impossible for that to be the case, and then we melt back down into the zone, and that's the UTAD. It's happened before. But ideal scenario is we get a jab, kind of like what we did right here, and we very quickly return to the range and continue lower. This particular scenario, nice amount of liquidity captured, came back into an order block and fair value gap. I think we got a little bit more gas in the tank to sweep this one more time, based on what we're currently seeing in terms of price. So again, you want to keep your analysis simple. Now, how can you actually look to actually take trades and position yourself for these, high risk to reward ratio plays? Okay, well, there's not the best example that I can give to you here with AU at the moment, but what I can go over is a couple different things. Okay, I want to talk about golds, which I think I had marked up on this chart here. A couple different things on gold that we'll take a peek at, and this is some smaller time frame, stuff we're going to be taking a peek at. And again, I want to remind you guys that the higher time frames will always trump smaller time frames. But if you want to get to a point where you're consistently hitting some really good risk reward ratio setups, you've got to start taking a look at the relationship between time frames. So higher time frame bias, smaller time frame entry. Doesn't mean you have to play around in the 1 minute and 5 minute. You can, and you'll find some of the best risk reward ratio opportunities on the smallest of time frames, but you want to keep it simple. And let's be honest. You guys let me know in the chat. How many of y'all have found yourself on the 1 minute time frame and you've gotten stopped out? And then you take another trade on the 1 minute time frame and you get stopped out again. And it's like, man, I could have sworn I was looking at an accumulation schematic on this 1 minute time frame and then it just wasn't. Or I was looking at this and then it just stopped me out again. Right? And it just keeps stopping you out and stopping you out and stopping you out. So again, the higher the time frame, the more consistency you will find with your analysis. And also, I want to encourage you to do top-down analysis, but not spending too much time on the smaller time frames because you don't need to always be entering on the 1 minute to get these crazy risk reward ratio setups. And let's be honest, you guys let me know in the chat, yes or no. Is it easier for you to hit a 1 to 3 than it is for you to hit a 1 to 20? Can you do it? Like if I told you, okay, next trade, if it's not a 1 to 20, you gotta, I don't know, like give me $100,000. Okay. How many of you are going to be like shaking it trying to find like the perfect opportunity and you're probably going to overthink and you're probably going to hit stop loss and you're going to have to give me 100K. Whereas if I just tell you, okay, here, if you can hit a 1 to 3, I'll give you 100K. Next trade, without you going to stop loss, hit a 1 to 3, I'll give you 100,000. How many of you guys are going to be lining up and being like, dude, I got this 100%, no problem? Probably a lot more of you. So the point isn't to 1 to 3 is beta. That's hilarious. 1 to 3 is great. I think 1 to 3 is like a good standard for a minimum. 1 to 2 at the very least. Okay, favorable risk to rewards are of course always going to be the ideal, but it is possible for you to take higher risk to reward ratio setups when you understand the relationship between time frames. Am I saying that you should spend a bunch of time on the 5 minute? For most of you, no, because it's going to confuse you more than anything, and you're going to continue to lose capital because you're not trading on time frames that are more consistent. It's not to say that the 1 hour and the 15 minute or the 4 hour and the daily are any less confusing. Sometimes you look at the chart and you'll be like, you take a look at golds, for example, right now, you might be like, dude, I have no idea what price is going to do from here because it's just been choppy. It's just been sideways. You're like, I have no freaking clue. I think we're about to take this low maybe on the session. That'd be cool. But I want to show you guys an example of how understanding, the three drive principle can really, give you some great results trading on smaller time frames, but also understanding the bigger picture. Because I think that's a big thing that we overlook as traders sometimes is it's not a terrible thing to look at the smaller time frames like the 5 minute and the 1 minute. It's just what is the context of the area that you're looking at those time frames. For example, for me this week, I had an area on gold, a couple areas on gold that I was taking a look at, and then I was looking for opportunity. But I'm always starting on the higher time frames. So here we were on gold, okay, and what I was looking to identify was some sort of a reaction from this fair value gap. All right, we had a pretty bullish reaction on Monday. Wasn't expecting it. This was a trade idea that was shared not from me, but from another educator in the platform. Caught a phenomenal, phenomenal trade. I was like, wow, this is a great trade. I didn't actually participate in it because I was asleep when it was called out. But phenomenal, phenomenal trade. It was like a 1 to 8 risk to reward. Really great trade. Casually shared 1 to 8 risk to reward. Really, really good setup. But this was a zone that I was liking for opportunity right here that we have on screen. And so the hourly time frame is where I'm basing this point of interest. As we continue to play out price, this was like 10 p.m., 11 p.m. Usually I'm not trading at this time, but we start to get into this point of interest, right? 11 p.m., we get a wick reaction off the 50%. 12 a.m., we start to trade a little bit lower. There's that sweeping of the lows. Looks like we did react off that initially. We have reacted off that whole level of 32.50. Trade a little bit through it. Come back to gold on that in another couple minutes. But taking a look at this, okay, we start to print inside the fair value gap. Ideally, is this Don's perfect world? No. Yeah, I want to see clear, clean wick reactions out of fair value gaps. That is like Don's perfect world you know, written on a sign and just stamped on my forehead. Okay. Is this the perfect scenario? No. We got a few candles printing in the zone, but think of the time that we're trading in the zone. It's like a weird time of day during Asian session, to be fair. But we do end up closing outside the range again. And then we trade back into the range. It's like 4 a.m. Okay. London sessions printing, doing its thing. Okay. I wake up at around 7 a.m. That's when my alarm is set every single day. So 7 a.m., I'm looking at the charts and I'm like, okay, we are consolidating inside this hourly time frame fair value gap. So I go down to the smaller time frame. And immediately on the 15 minute, I start to look for the same things that I was referring to you guys to keep it simple earlier. So, number one, I'm looking for liquidity captures. Number two, how many times have we captured liquidity? And when I take a look at this, the move lower, we did have a sweep of this low. So, I'm going to look at this. This is like first drive. We then have a second drive here, and we get a rally to the upside. Okay, this was during the Asian session, but this is a second drive. And it's now 7:45. There's a order block as well as a fair value gap on the smaller time frame that we have yet to, and this is the hourly time frame as well. This whole blue zone's the hourly time frame fair value gap, but you can also see it on the 15 minute here. All right. We've got some overlapping lower points of interest here. Okay, now not only that, we also had the whole level at 3,300, which was significant to me. So if we were to take a look at this from a Wyckoff accumulation perspective, because this is what we're starting to see potentially develop here, you could actually look at this and be like, okay, here's your preliminary support, your seller's climax, you got your automatic rally, your ST, the break above the high. This is like the top of the accumulation range, right? And we're just chopping sideways. We then get a move lower going into the later part of New York session. We actually got a sweep down to this low at around 8:20 a.m. Okay. Now, normally you wouldn't count the preliminary support as a drive, by the way. Um, if we're looking at this and counting the drives from the start of a accumulation, this is your seller's climax. We know that because you got a change of character afterwards. Here, we trade in the 50%, we get a bounce, but there's not like an official change of character that takes place, right? You can really see that on the line chart. There's no, you know, low. I guess it's maybe a little bit of one right there. Okay, but this is a lot more clear where we were getting lower lows and lower highs. We then get a high, higher low, higher high. That's a change of character. Okay. But nonetheless, taking a look at this, we have a clean sweep of liquidity beneath this low as well, down to that kind of 33. This is actually 33.01, where this particular buy was executed from. And I did have buys from this low that I was taking. Okay, we'll actually keep this here. All right. We'll actually mark this out too, because I think it's good to mark out, your kind of range for an accumulation schematic. Okay. And then, yeah, if we continue to play this out, we'll see that this thing gives a beautiful, beautiful reaction. So this is like a higher time frame, fair value gap fill, also a smaller time frame, kind of overlapping, order block and point of interest. So we start to get an initial reaction from this zone. Now, here's the cool part. Okay, this was a position that from the 5 minute and 15 minute had about a 70 pip stop loss, and I was targeting these highs to be taken out at like 33.50, 33.60. So that already gives a pretty nice risk reward. That's like a 1 to 7. Even at the high of the range, you're looking at a 1 to 3. That's a good trade. Okay. That's favorable. It's good. Here's where it gets exciting. When you get a reaction after having seen that this is a very clear liquidity capture, okay? Very clear. It doesn't take, a genius to take a look at this. If you have a basic understanding of liquidity and smart money, you can look at this and pretty easily say, okay, this was a pretty clear liquidity grab, right? Because we got a V-shaped recovery right back into the trading range, and we're starting to see price run away. Now, 1 minute time frame again. Do you want to live here? No. But if we're taking a look at the price action for where this liquidity capture took place, we had, price trending lower, chopping around sideways, quick movement lower for the liquidity capture, followed by a market structure shift on the 1 minute right here, right? Or a change of character or a break of structure, depending on how categorize this movement. Everybody calls it something different, it seems, nowadays. Okay. Look what price does. We trade right back down into the extreme of this order block. Last down candle that did the most damage prior to this up move, reversal. Okay. Guess how you can look to enter off of this for a re-entry. There's also a fair value gap in here. Okay. Even if you wanted to be safe in entering the position, maybe we don't trade this low. Sometimes you won't get that deep of a retracement on the smaller time frame. You're taking this, you're now stacking an entry. This is actually still a pretty big stop loss. But you're stacking an entry with similar targets. So even though, okay, you're still taking, you're stacking an entry here, right? Maybe you've reduced this position to, instead of you risking 70 pips, now you're just risking to this low. You want to take what you had originally risked and add it to your position here. That way you're not risking twice as much just because it looks like an accumulation is going to play out. No, you want to take what you were originally risking, you de-risk the initial position, and then you add that risk here. This is assuming you're, trading at a high level, understanding price action accurately. The anticipation is for us to trade and take out these highs. That's kind of like the target here. Okay. If you wanted to be more refined with your entry, you're entering off of the fair value gap here, stop loss beneath the low. It's now a bit more of a tight stop loss. Targeting that same high is now almost a 1 to 5. This is just a 1 to 3. on the 15-minute and kind of 5-minute entry. Okay. But again, what's the point of us doing this? We're taking what would normally be just a 1 to 3, risking, let's say you're risking 1% of your account. Okay. 1% of your account, 74 pips, reduced down to, you know, we'll call it 13, 14 pips. Well, now you're risking much less than 1%, and you've opened yourself up a lot more room to add to your position here once you've gotten evidence of the reaction. Okay. You're still only risking 1% on the trade, but now it's like you took the 1%. Now you're actually only risking the lot size is the same as if you were risking 1%, but your stop loss is trailed. So now you're only risking, I don't know, we'll call it 0.2%, even though it's less than that. We'll just call it 0.2%. What are you going to do? Well, you're going to apply the rest of that here. Now you're stacking. You guys remember what I mentioned, how it's easier to hit a 1 to 3 or a smaller risk reward ratio setup than it is to hit a 1 to 20? Well, what if I told you in the same 1 to 3 setup, you can actually get yourself stacked on positions to the point of it being the same value as a 1 to 20? Because now you have a 1 to 3, risking 1% to make 3% from the initial trade. You de-risk, bump up your stop loss. You're reapplying what's left over on the next position, which is now, depending on your entry, either another 1 to 2, almost 1 to 3, or ideally with a more refined entry like this one, almost a 1 to 5. You're reapplying almost another full percent on that trade. Now you got a 1 to 3 plus the we'll call it a 1 to 4, because that's probably what it'll equate to. It's just under a 1% risk on this. So now this is like a 1 to 3 move that's paying you 1 to 7 at the first target. If we play this out, okay, this thing chops around, we trade higher. At this point, you're break even on both positions, by the way. And you could choose to stack or just let it ride out, let it do its thing. But at least we're looking for a run on this high. That's the ideal scenario. Okay, we continue playing this out. We get a huge sell-off. So what happens? Well, your two positions get hit out break even. If you didn't pay yourself because we didn't reach the top of the range, it is what it is. Maybe you decide to pay yourself at these highs, so you're at least partialing. Okay. This is what happened to me yesterday, literally. Okay. I had a position, this thing ran, and then I got hit break even. And I was devastated. I was like, what? I could have sworn 1, 2, 3. And I was like, wait a minute. But I'm counting the first drive as the preliminary support, not the seller's climax. Technically speaking, the first drive is the seller's climax. So this is that true spring that we end up seeing here that plays out. So I end up re-entering from basically the same zone. Okay. And this time I actually have an even better position because it's like smack dab off of 3,300. This one was from like 3,301. This was like smack dab. I think it was like 29.99 or something. And stop loss was on the 15-minute at around 29, or sorry, 29, 32.94. Okay, I want to make sure that this is accurate for you guys. And I'm targeting the same thing. First high, 33.25, first target, second target, 33.50 approximately. Now my entry is actually a better risk reward. Did I get hit out of the first one at break even? Yes. Did I not pay myself? Well, you guys are going to hear me being fully transparent and honest. I did not take any partials on those positions. So I didn't make a dime from the movement, despite it being nice. It was like a nice move from here to here. It was almost 200 pips on gold, but I didn't pay myself. Got hit break even. Saw that this was another liquidity capture. We can see that this low did in fact breach the previous one. And so I recognized that I was looking at this a little bit incorrectly for the accumulation. And this was the first drive, second drive, now third drive Again, we're getting liquidity captures here, here, and now here. Took that entry, and same thing, smaller time frame. I was looking to stack positions here. So all throughout this range, we get a nice reaction. Price is, kind of doing its thing on the 1 minute. At this stage, no sort of didn't go break even, didn't sort of, add to my position at this point. I was actually kind of surprised we returned back to the same entry level again, but we do. Then we get a bit more of a move with conviction here to the buy side. And at this point, I'm looking for opportunity to add to my position now because this is enough evidence. Okay, here it was like clear evidence, like V-shaped recovery, market structure shift. It made sense. Here, a little bit different. I mean, we basically fell off a cliff. So I need to see a little bit more of a movement to get evidence that I'm going to want to, add to my position here and de-risk. So at this stage, after we get this jab and we see this move higher, I decide to go break even on my trade. What does it mean when you go break even? Well, now you're not risking a thing. So I can reapply that 1% risk or whatever it is that you're risking to a reentry opportunity. Okay. I ended up stacking on this thing. Let me see if I can find the screenshot. I'll actually show you guys the amount of times that I stacked on this. And it was this was a battle. Gold and I we were battling yesterday. Let me share my screen on my phone real quick. Can you guys see this? You guys can see this, right? So I had positions on gold that you guys can see that first position that got hit out right here. Okay, blue arrow was entry, red arrow was where I got hit out. I ended up re-entering at that 32.99. Ended up holding and not actually re-entering. You could have technically re-entered. I don't think I can annotate on this. Oh wait, yeah, actually I can. Let me go markup. Okay. So this is the 5 minute time frame, by the way. So when this high gets created and we get a pullback to basically this order block, I could have technically added to my position there. And I watched this happen in real time, so I could have. Because at this point, my stop loss was already break even. Okay, my stop loss was actually trailed in this screenshot to this level. But at this stage, my stop loss is break even. I could have reapplied my 1% risk on this low, and it actually would have been ideal for me to do that. Entry at this low, stop loss beneath that low. Because think about it. I mean, I had 1% that was initially applied on this, got the reaction. Now I'm break even. If I'm understanding where we're at in the accumulation schematic, because I'm looking at this as an accumulation, here's your spring. We get the move. Here's your test. Why would I not, when I'm now break even on the position I was risking 1% on, reapply that same 1% here to not be risking more than I should be on the trade, but to stack for the same targets? So pulling back up, then you guys will notice I stacked here, here, and here with smaller positions. And then as we got this break higher, I actually stacked again with a heavier position right here. And, notice how I was also paying myself on this trade, which is nice. Actually partialed on this one before getting hit out break even, because believe it or not, this actually did get hit out break even, a lot of this. But I'll pull this back up once again. So here is a 5 minute time frame. Is this making sense, by the way? So it's like you're basically taking not too crazy risk reward ratio trades. Like this trade, before it was risk-free setup. I mean, ultimately I'm looking for a 1 to 8 full target, but I'm being conservative, looking for a high that I think is reasonable at the top of this range. Liquidity capture, even just targeting this high at 33.20. It's 1 to almost 4. I'm risking 1% to make 4%. Now that the trade is running in my direction, I'm taking the 1% that I was risking on the trade off the table and going break even. And I'm just reapplying that same risk on the same move, understanding the bigger picture of where we're going and kind of how it all aligns with one another, so to speak. So on this pullback, which we're about to see, on this pullback, this is like going into 1140. So normally I don't even trade this long in the day. But as soon as we end up trading back into this order block, I could have in theory taken another entry, proper English, taken another entry, stop loss beneath the low, okay, reapplying another 1% risk with the same target. Is this a great risk to reward? I mean, it's 1 to 2 could be better for sure. But I'm now adding to what I already have as almost a 1 to 4 from this trade, another 2R. So now the 1 to 3, 4 becomes a 1 to 5, 6. Okay. You could probably get so good. I know some guys that are just crazy. Like they'll take setups, just one setup, 1 to 20 banger, tight stop loss. Like I had a setup on golds earlier this week. I've been practicing this a lot on smaller time frames because the smaller time frames are it's just a different beast, right? Different beast. Especially with gold, because a lot of people don't know this. Gold, I only really started trading gold like a year and a half ago. Like seriously, like last year, to be honest, is when I really started to take gold more seriously and pay attention to it more. But anyways, digressing here, we continue to see, and even this, like we're just getting liquidity captures, right? Smaller time frame liquidity captures, healthy price action on the way up. If we jump over to the 5 minute and continue to play this out, we end up getting a run on the highs eventually here. Okay. So now I'm positioned, or I could have been positioned. I actually wasn't in this instance, but I could have bought on the test here. And now first position is running 280 pips in profit. This is looking good as the breakout of the accumulation, right? You've got your preliminary support, seller climax, automatic rally, ST in phase B, followed by the spring. There's your test. We actually entered on the spring, had entry opportunity on the test. We get the breakout, the sign of strength. And as we continue to play this out, there was opportunity for me to add to this position a couple more times. Okay, so I ended up adding to my position. Right, we end up coming back into kind of this is like almost like the 50% of this range of the accumulation. We come back to almost the 50% here. We're basically at the 50% of the accumulation. And at this point, I was just stacking for fun, and usually I don't trade in the afternoon. So I was just like, yeah, you know what? Curious to see how this ends up playing out. And we'll talk about it on the Wyckoff session, which, now we're talking about it. I was showing you guys that screenshot. This was literally from yesterday. But I understood that there's one of two things that were going to happen. We were either going to come and react off the top of the accumulation and just continue higher. So like right here, we were just going to continue higher, or we could trade deeper. So I layered into my trade, entering off of the open of the fair value gap. And I believe where was the second entry at? Open of the fair value gap. I think it was the full fill of the fair value gap. And then after and these were like 0.01s, nothing crazy. But again, in anticipation of the continuation higher, because usually we'll get this official mark up. And after getting this sell off, we start to accumulate. There was a 1 minute candle that I added the rest of my position on. Um, this was yeah, this is a little bit after this. Actually, it was a 5 minute candle. When we dip back down into this is where I added on the rest right here. There's a nice little sniper entry there. This one went break even on it pretty quickly as well. And this actually ends up getting hit. Actually, hold on. Yeah, this guy hit a break even like immediately afterwards. So as soon as I started to see this, I have at this stage two entries layered in here with very minor risk. I have my main entry from 3,300, or actually, yeah, 3,300. Could have had another entry here, right? These smaller positions, it's just in anticipation of us going higher. Wasn't really too focused on them. And then we start to get this kind of price action. Immediately, my mind goes to, okay, sure, it's the afternoon at like 2:30, 3 o'clock. Now it's like 6 o'clock back here at this point in time. You know, I'm looking at this and I'm starting to realize that this is starting to, based on how slow we are here and how it's lacking that kind of desire to go higher. You can kind of just tell by price action, it's lacking the desire to continue higher. This accumulation is starting to potentially be and print as if it was a failed accumulation, turning into a redistribution to go lower. Why? Because this returned back into the 50%. We got a bit of a bit of a reaction, but price isn't really doing a whole lot. We don't continue with strength higher to create a new high. It just starts chopping sideways. And yeah, time of day has part of, a part to play in this. But ultimately, I'm starting to look at this and realize that this could very well be the high of a redistribution to go lower. Now, keep in mind, I'm risk-free on this position. If I had entered with 1% risk here, it's off the table, it's risk-free. My layered in trades that were on the retracement back into this were not with full risk. It was literally 0.01s. So it's like maybe 0.2% on the table. And the position that I did have re-entered here got hit break even. So at this point, I'm at a point where I need to kind of have a conversation with myself. Now, mind you, I did take partials already, so I'm up on the trade overall. But at this stage, I need to decide, okay, do I want to cut my trade here, hold to break even, or what is the scenario that makes the most sense? And when I start to see price action like this, I'll be so honest with you guys, I close. Why? Because 9 times out of 10, after an accumulation like this, if we start to slow down and not see a continued move higher, because notice again, this is like not proportionate as well. Even if we were to box this out, this is not a proportionate move. This wasn't even close to what I was anticipating for a proportionate move. So now I'm starting to think, okay, chopping around, sideways price action, boring. Now it's like Asian session. I'm going to close this thing out because it's looking like we're going to end up being turned into a redistribution at this point. Sure enough, if we continue to play this thing out, we end up seeing even the 15-minute time frame looks super ugly. You know, we end up seeing some pretty wild price action, but this does ultimately end up being, and we'll see it going into London session, a redistro. So where we saw a failure to duplicate the move higher, right? We barely tapped into, where we were anticipating. We did, in fact, going into London session, see a successful duplication lower because this ended up actually being a redistribution schematic. But cool thing about this, I still made money on the trade because I was able to effectively identify multiple liquidity captures and take entries to then partial at these highs. So even if you're looking at a zone and you're like looking at it from one angle, one perspective, and you start to realize, oh, wait, this might go the other direction, you can still be in a profitable position despite being, quote, wrong on the initial bias. And the way that you're going to get to a point where you're catching 1 to 20 risk reward ratio setups consistently isn't maybe in the way that once thought you would, where it's like actually a 1 to 20 risk reward. Of course, you can get to that point too. But even more simply is just stacking entries, understanding where we're at in regards to or in relation to Wyckoff as a whole. So, with that being said, I mean, this is just an example I wanted to spend a bit more time on. We could obviously, go into even greater detail. We had this mark lower on golds in the time that we were kind of overviewing this. We're still kind of chilling at 32.50. Could we get a reaction off this? Yeah, I think we can. But I'm again looking at this whole schematic. This is like a fractal. This is like a 15, 5-minute schematic inside the overall, 1 hour time frame consolidation that we've been in. Two scenarios for me on this. Okay, we have either, ST and B, right? Another liquidity capture to move higher. Or this is the breakout lower that will, then at some point be followed by a retracement to continue lower. And I think we got reason to believe that gold could trade beneath this major quarters, theory level. If we're taking a look at this on the daily, we haven't even come remotely close to the 50% of this range. You know what I mean? Sure, we're inside this fair value gap. We've been in it, chopping around sideways, not doing a whole lot. So I am anticipating a return to this zone on gold based on what we're seeing. This is like, you can even see it on the daily. Failed accumulation turned into a redistribution. Even if we were to duplicate this just on the daily, just for fun, where does that get us? Beneath this low at the very least, maybe down into this range. So I hope you guys saw, got some value from this. Do you take lower time frame for value gap reentry as well? Sometimes, yes. Yeah, sometimes I will. Stacking entries, reducing risk to break even, and taking partials, big cognitions that have been helping a lot. Awesome. I'm glad. Now, you also want to know when to not be, applying full risk on every reentry because you could, walk price up and always be risking 1% and then, be at a position where, it's not as optimized. But there comes a point where, re-entering and re-entering and re-entering may not be favorable, but most of the time when you're getting reactions from zones, you can scale down to 5-minute, 1-minute price action and find some decent scaling in opportunities, even just stacking, twice on an entry. You get an entry out of a point of interest, stack another one after you get the confidence in that reaction. It can be favorable, If you can stack a third time, great. But you don't need to go overkill, right? With stacking. So all the resources as we're coming to the end of the session. All of these resources are going to be emailed to you guys. As long as you registered for the session, you'll receive an email with the recording as well as the resources that are in this folder. And so just stay tuned for that. Look out for that. And that'll be forwarded to you guys after the session, probably tomorrow at the latest. So just stay tuned for that. And the slide deck's also in there as well. So if you guys have things you want to pull from the slide deck, you absolutely can. And we'll probably continue doing these Wyckoff sessions. We'll continue doing these Wyckoff sessions. I think there was a chart that Mike had dropped that I didn't get a chance to pull up. I wanted to pull this up here. I think he was talking about it being looking at a distribution. It looks like it was a distro. So this is 15-minute time frame. 15-minute time frame distribution. Yeah, this is a great sell. This is a great sell. Distribution schematic. Yeah, so this is like a solid. I would be looking at this as a redistribution because we didn't really get. I mean, this is interesting price action on gold for sure. But I think yeah, either way, markdown from here, definitely made sense. Definitely made sense. And this is even before we got this meltdown beneath these lows that he sent this out. So this is a nice trade. Nice trade from 3308. Got you guys. Got you guys. Appreciate the love in the Zoom chat. But cool guys, sweet. Yeah, so we'll continue doing these. I might not do them every week or every 2 weeks. It might just be like sporadic here and there. I want to get some even better back tested examples to take a look at with you guys. And obviously I'm going to continue to study and immerse myself in Wyckoff because I think it's such a cool understanding, cool ideology to have, and it's something that's really served me well in my trading. Definitely a lot to take in. Obviously, these sessions are a bit lengthier. I love these sessions, to be honest. Like doing lengthy sessions is kind of like my bread and butter, to be honest. I love doing it. But yeah, hopefully you guys got some value, man. Hopefully you got some value and you can take something and apply it. I think the most simple takeaway is just ask yourself how many liquidity grabs we've seen. Look for three drives, two at the very least, and be positioned where you're trading off of smart money points of interest. You're trading off of institutional points of interest, like order blocks, fair value gaps, whatever have you. But also just keeping in mind in the back of your head, okay, how many liquidity grabs have we seen? Are we in a position where we could be getting another liquidity grab? That kind of conversation in your mind can be supportive in your endeavor to be profitable trading and not be stop hunted, right? But cool guys, sweet. So we're gonna wrap it up there. Enjoy the rest of the week. And I'll throw this out there as well. If we're not working inside the same company or community and you're interested in working together, because I know this is open to the public, happy to have a conversation. DM me something on Instagram, Revolt maybe. DM me the word Revolt, Revolt, and happy to have that conversation. See what it would look like to potentially work a little bit more closely. And yeah, we're having a lot of fun inside the Revolt community. So it would be great to have some more of you guys in there. But with that being said, fam, much love. Enjoy the rest of your Wednesday or Thursday or whatever day it is that you're seeing this on the recording. Peace out and catch you guys very soon. Let's see if we can get the fireworks going to end it off. Boom. There we go. There we go. Awesome, guys. Take care.